What is the aim of this conference? Its aim is simply to ignite debate. The current financial crisis has raised numerous discussions, both in the US and the European Union, and a reorganization of the financial supervision appears to be unavoidable. And also the creation of a European system for supervision and crisis management, now nearer back home, especially a supranational supervision of cross-border active financial syndicates, becomes necessary. In this conference, speakers proficient in economics and European law from the United States and the European Union shall analyze the approach of our respective governments and representatives. They shall try to point out and adapt common needs.
In his speech on Wall Street a few months ago, President Obama spoke of the blind faith which led home buyers and derivative traders to make irresponsible choices, with consequences for the world economy. A number of solutions have been discussed on both sides of the Atlantic. The U.S. Congress stipulates in the Dodd-Frank Act of 2010 that the aim of the legislation, our legislation to enhance regulation, was, quote, to promote the financial stability of the United States by improving accountability and transparency in the financial system, to end too big to fail, this concept that certain institutions are too big to fail, to protect the American taxpayer by ending bailouts, to protect consumers from abusive financial services practices, and other purposes. As the U.S. works to carry out the Dodd-Frank Act, we are mindful that in order for us to remain a desirable place to invest, we must put in place a framework that engenders the trust and confidence of not just Americans, but also investors around the world. We live in a global marketplace. Dodd-Frank puts us in a position, I believe, to lead internationally and foster a race to the top on reform, while working with our counterparts in other countries to ensure international consistency. Treasury Secretary Geithner has spoken publicly and often about the need to ensure international harmonization in our regulatory environments. As most of you in the room know, he was recently in Poland, and he and some of his European colleagues did not see 100% eye to eye on some of these issues. But the important fact is that he was there, and the major problems of the day could be discussed from multiple perspectives. In our experience, discussions of this nature can only lead towards a better solution. All participants can learn something from these discussions. And as he said when he returned to Washington, quote, Europe is obviously under a lot of pressure, and they face a lot of challenges, and it is affecting us. It is affecting confidence here and around the world, not just in Europe. And we have a huge stake as a country in helping them deal with these challenges. So we work closely with them, and we're supportive as they try to craft a more effective strategy. And indeed, we have our share of problems in the US as well. We have all lived through a very sobering financial crisis, and one from which we have not yet fully recovered. At times like this, it is entirely appropriate for us to consider lessons learned and to respond with appropriate reforms. A healthy, well-functioning banking system is one of the characteristics that distinguishes healthy, developed economies from less developed economies. It is crucial to our economic well-being. We regulate banks to make sure that they can continue to perform the role that we need them to perform. Our speakers today will discuss some of the far-reaching changes to the regulatory and supervisory standards taking place in Europe and the United States in response to the recent financial crisis, changes in various stages of implementation. As Secretary of State Clinton said recently, quote, "I'm confident we're going to weather this crisis, and not just our country, but also our partners around the world, most particularly in Europe. Europe and the US can move together to establish safeguards that strengthen financial stability. We need, frankly, uniformity in global markets to avoid financial mercantilism or arbitraging markets. We need strong oversight. We need consumer protection. We need healthy balance sheets. We need intelligent risk management. These kinds of measures will be of equal benefit on both sides of the Atlantic."
The securities regulation of products, like credit default swap, like money market mutual funds, proved, I think, insufficient for the economic purpose of those products. And just I'll say a word, when I say securities regulation in the United States, this has been largely focused on a disclosure regime. The purpose of the regulation of securities products was to make sure that the investors understood the risks that they were taking. It wasn't from a prudential point of view to say, are these good products, are these bad products, should these products be out there, or can the companies truly stand behind the products? If the individual investors wanted to bear the risk, as long as they understood the risk, this was considered acceptable. Obviously, this differs greatly from an insurance or a banking regulatory perspective, where there's much more emphasis placed on capital in the institution. Can the institution stand behind the promises that it has over a longer time frame? And particularly from a banking perspective, providing a safety net behind the banks to prevent runs on the banks. So the United States, really going back to the Great Depression, had at least implicitly decided that the securities world did not present systemic risk, and it was really not regulated as if it presented systemic risk. So, as we examine this sort of post-Dodd-Frank regulatory system within the United States, what can you say has, quote-unquote, really changed? Obviously, as I said, the structure has changed. There are additional legal authorities that the regulators did not have prior to the Dodd-Frank Act. The role of this new Financial Stability Oversight Council is in many ways the key to avoiding future crises. You had a presidential working group on financial markets. You had a Federal Financial Institutions Examination Council. If the head of, for example, the Federal Deposit Insurance Corporation needed to talk to the head of the Federal Reserve, they had telephones. In truth, the banking regulators in the United States prior to the crisis had very significant authority. True, they didn't have it over the entire system, but you could, for example, have indirectly regulated derivatives to a large degree because the banks were a very, very large part of the derivative market. So the question going forward is really how the regulators use the authorities that they have to hopefully avoid a future crisis. Of course, as I said, that's to be determined.